With me on the details. Abby.
And as a result of this bearish pre-announcement to the downside, Manus, we have this stock plunging more than 10%, heading to the worst day in more than 2 years. Now, of course, Humana focuses on Medicare. They cut their outlook for 2023. They're also forecasting anemic enrollment growth for this year relative to the 2023 profit cut. They're now looking at $26 per share versus greater than $28 per share. I will note those are massive numbers, but still not what the street was expecting. And this has to do with rising costs as there's been an uptick in care usage by seniors a trend that started mid-year last year. This is also a warning call for Medicare Advantage plans. That's a private version of the U.S. healthcare program for seniors. It's driven growth and profits for some of these insurers for years, and it now seems as though it's slowing. The stock into today on some of these bumps had been down about 8% over the last year, and again today down more than 12%, heading to its worst day in more than 2 years.
Okay, well, let's talk a little bit more about tech and turn our attentions. I mean, it's been a rough 24 hours for Apple. It's, stopped selling its watches with the blood oxygen feature, and it gets snubbed by Netflix. Ed Ludlow arrives with me, I think, with a bit of good news for Apple. Ed, how are you doing?
Yeah, good. I mean, I count no less than 4 clear standout stories about Apple in the last 18 hours alone. The main catalyst for the stock to the upside is a Bank of America upgrading the stock to buy from neutral, principally due to their bullishness about the Vision Pro mixed reality headset. They see that being a driver of hardware sales and services. They're also confident about the upgrade cycle for future iPhone. The stock up almost 2%. In the context of the Vision Pro, the other news story that came out was that Netflix has opted not to create a Vision Pro specific app. In other words, you won't be able to use the Vision Pro to view content or material through a designated Netflix app, and instead Netflix will direct its consumers to other digital apps and web browsers for that tool. I don't think that had any sort of substantive bearing on the stock. Probably the biggest one of the last 24 hours is that Apple has lost an appeal to extend a pause or an exemption from that ITC band on its latest generation watches. And as of today, they will sell the Series 9 and Ultra 2 watch with the hardware capable of blood oxygen monitoring, but it will be disabled as that patent dispute with Massimo continues. And by the way, Manus, the Massimo CEO will be on the show with me later today, and I invite questions from our audience around the world. But we're just at the beginning of this appeals process, and Apple is very much bullish about its appeal.
Yeah, you just wonder where the compromise in that deal is. Thank you very much, Ed Ludlow, with the very latest on tech and Apple. Let's stick with the theme. Amazon is making a restructuring deal with Diamond Sports Group that will save the local broadcaster from bankruptcy. Emily Gray-Foa joins me now. Emily, what's the rationale here for Amazon?
Well, Manus, that's a good question here. Amazon had actually been in talks with Diamond Sports Group late last year to come in and create this minority investment. And one positive here for Amazon is that now its users will be able to watch live MLB and NBA and NHL games through purchasing access with Diamond Sports Group. But I'll talk a little bit more about this deal because Diamond Sports Group, a unit of Sinclair, had filed for Chapter 11 bankruptcy last year, and they were actually talking about winding down the company until those talks with Amazon began. Yesterday, we saw the stock of Sinclair pop about 17%. Today, not moving that much, actually now in negative territory after the open. The Amazon stock just up a little bit higher, but we do know that there's still some talks about whether the deal will actually be able to go through. It does have to be approved by bankruptcy courts, and the MLB, the baseball league, actually said that this deal with Amazon was a big shock and will actually really change how the MLB does business with Diamond. But at least for right now, was good news for Sinclair, and net neutral, it seems like, for Amazon stock right now, Manus.
Emily Gray-Foa, thank you very much for joining us. Let's turn our attention to financial services now. Discover reporting a 62% drop. This was in the fourth quarter profits. It continues to grapple with the fallout from risk and compliance lapses. Isabel Lee is with me in the studio to talk us through the discovery.
Hi, Manus. That's a steep drop indeed, and that led to the resignation of their CEO last year, if you recall. So the company posted fourth quarter profits of 1.54 cents a share. That's lower than Wall Street's estimates of $2.52 a share. Operating expenses also climbed around 18%, and the company is also expecting that their operating expense this year will increase in the mid-single digits. Shares of Discovered tumbled around 10% in pre-market trading, and now you can see that it's still continuing to fall roughly around 7%. The CFO said that fixing its compliance issues could cost the company around $500 million this year. This all began in July last year when Discover misclassified certain credit card accounts, which resulted in some merchants being overcharged, and it also resulted to their shares being suspended. And that was only the second time in a year that their company halted stock buybacks. Some silver lining, we have KBW saying that optimism could be found around net interest margin expectations and the reinstatement of their share buybacks, Manus.
Okay, Isabel, thank you very much. To Deutsche Bank's Pinky Chadra, let's talk about the target. 5,100 is the target price for the S&P 500 based on a number of factors, and this is what he wrote. We're going to discuss a number of catalysts that will impact the trajectory. Rates versus rates volatility, the playbook for geopolitical risks, and the sell-off, the widely anticipated mild short recession, and the presidential election. So there's a lot to unpack there, Binky. Good morning. Good to see you. I'll ask you the same question as I asked my other two guests. You have a target of 5,100, which is a pretty significant number. It's a nice round number. How much of our journey to 5,100 is predicated on somewhere between 3 and 6 rate cuts?
For us, I'd say very little or nothing, basically. I think, if you think about the outlook 12 months out, and you think about it in terms of earnings and multiples, the main driver of the upside is really earnings growth. So our estimate for last year is $228. We don't have Q4 numbers yet in, but we go from 228 to 250 in our base case. So that's a little bit less than 10% earnings growth, and that's really where the upside comes from. Multiples look, some people would call them pretty full. We would argue they're sort of just beginning to price in basically, the recovery that actually has been taking place for quite a while, whereas the macro consensus, has sort of continued basically to look for a very steep slowing in growth. It continues to do that. It continues to get upgraded, and that really keeps the bar for growth to surprise positively. It keeps the bar very low, basically.
So, Binky, there's going to be a number of people tuning in here, and they're going to listen to that, and they're going to say, so we're going to get from 4,700, call it for cash, to 5,100 with no rate cuts. Now, that's not going to be a one-way journey because this market is emotional. It reacts to delayed rate cuts to a certain extent. So do you think in the near term, as we see delays perhaps to these rate cuts, some disappointment in equities which sets up a better entry level?
What I would say is, I would agree with that. What I would say is that, the lesson of the last 2 years has really been that it's not really been about the level of rates or the fact that rates, are higher than they were a couple of years ago. It's really been about, very high rates volatility, and that's what the equity market has basically moved with. So, the market pricing in, for whatever reason, too many cuts, and some of those cuts come out, you're going to get rates volatility, and it's the volatility that's a negative, but, the question is, will that volatility be sustained? So for that volatility to be sustained, things have to be continually basically changing, and there has to be a surprise. So would argue that, vol will come off as things settle down, and whenever vol has settled down, the equity market has basically rallied. So on the rates issue, I would argue it's really more about rates volatility rather than the level of rates.
Now, you remain neutral on megatech and on mega cap growth and tech. I'll get my sinking right in a moment. Neutrality. Why? Because I've got evangelist after evangelist telling me that AI, if it's got AI of substance and profit, it's worth having. Why are you neutral on mega cap?
Yeah, so I would say, we were long basically in late 2022 when there were no evangelists anywhere to be seen or heard from. It was basically at the bottom of the S&P 500. So we caught the rally in its entirety basically, but by June of last year, I'm sorry, in our view, it was really, we were very constructive on earnings and the fundamentals, but it looked to us that, it was more than really priced in. The second point that I would note is I would take a little bit of exception to the AI and the AI hype. If you take a look at mega cap growth and earnings,
please.
For the last 20, 25 years, what you will see is that basically, their earnings have been rising basically in a pretty steady trend channel. And yes, the pandemic took them to the top and a little bit above that channel. Fourth quarter of 2022, as the forward demand started to wane, the demand that had been pulled forward began to wane. We saw earnings go all the way to the bottom of the channel, and since the fourth quarter of 2022, what we've seen is a very robust recovery, almost back to the top. So the simple point I'm belaboring is that earnings have been in a channel for the last 20 years. They are still in that channel. So I would argue easily explained really by the cyclical surprise. And so far, there's nothing happening that suggests that there's higher upside. And that's actually why we are basically neutral, because what the market is pricing is that that we're going to go up and out of that channel.
Well, that's why we come to you, because you were ahead of the curve in the first instance. Can I ask you, yesterday we had retail sales. Today we've got nice jobless claims numbers. But I'm drawn to what Paul Donovan reminded me of from UBS. And this is just to get an idea from you about your consumer cyclicals. This is what Donovan said. Markets seem surprised by the U.S. retail sales were stronger than expected. This is weird. Some part of the retail sales data surprised positively every single month during 2023. So my question to you on that is, you are overweight financials and consumer cyclicals, and you believe in the hedonism, I presume, of the U.S. consumer? You're not worried about delinquencies, credit card spending? There's no level of concern?
Of course, you always have to be mindful of the risks, but given the world that we've lived in for the last year and a year and a half, which is almost every macroeconomist calling for a very steep and sharp slowdown, maybe into negative territory, maybe slightly positive, but a steep slowdown nonetheless. Mm-hmm. And what I would suggest is leave the narrative of the last 6 quarters, which really hasn't worked, and look at the data. I mean, if you look at PCE spending in the U.S., it's almost 70% of GDP. It's rising very steadily in a trend. On the good side, I think the story that is missed, so I'll come to retail sales in a quick second, but what we had is a tremendous surge for reasons that we all know and understand now, well above sort of trend levels at the height of the pandemic and the pandemic boom, so summer of 2021. Then we had a period of good spending basically going sideways. But since January of last year, they hit the trend channel and good spending has basically been rising steadily. So you could actually argue there's nothing to see here. Now, if you take retail sales, what I would argue is you want to look at them in real terms, because a big source of confusion has really been, how much is inflation, how much is real. Retail sales are, of course, reported in dollar and nominal terms. If you look at retail sales in real terms, you will see again that basically, we're rising pretty steadily in a trend channel. And again, there's not a whole lot of news. I would say that yesterday's print was a little bit better in the sense that within the channel we moved up a little bit. But I would not argue that it's a huge or a big change. What I would argue is that this has been ongoing for 3 years. It is the narrative that is at conflict with the reality, and so we shall see who wins.
Yeah, as you say, it's putting the context around that consumer. I'm drawn to your thesis on buybacks. You played out very clearly what happened at the start of 2022, where we ended 2022. And typically when we start the year, we see lots of notes come out, get ready for buybacks, get ready for it. But you contextualize this as we are at the bottom relative to where we have been since the GFC. So it's not going to save my soul or my equity portfolio a bit of buybacks this year?
I think, the things to note are that buybacks basically come out of earnings. And so, you use earnings to pay dividends, to do CapEx. And then, one way to think about it very simply is what's left over gets paid out as buybacks.
Yeah.
And what we have is a very large disconnect in 2023, which is 2022, earnings are coming down, so buybacks are coming down. In 2023, earnings rose, each of the first 3 quarters. Our estimate is that they did so again in the fourth quarter. What you've seen is buybacks go sideways to actually slightly down. Mm-hmm. So the ratio of buyback payouts relative to earnings, has fallen sort of to the bottom of the range. First question is, why have they done that? We would argue it's the same story, which is that, it's the uncertainty about what the cycle is going to do and what growth is going to be. But growth's been above trend for 5 quarters prior to the fourth quarter of last year. So, and I think that, it's very likely that it'll be 6 quarters of above trend growth. And so at some point, if this cyclical uncertainty starts to lift, a catalyst number 1 should be the reality of the last 6 quarters. Then you should see buybacks start to come back. Buybacks since the global financial crisis have been, the largest, basically, source of demand for equities. Mm-hmm. And so our expectation is that buybacks will pick up in the first or the second quarter.
Okay, well, we wait for those to come through. Binky, thank you so much for being with us. That is Binky Chadha with his course 5100 without rate cuts that the market has penciled in. I just need to bring you a correction from a little bit earlier in programming. We played a soundbite for you for the spokesperson of Pakistan's government, and we accidentally said that they were from the Iranian government. We apologize for that mistake. Okay, let's turn our attention back to the World Economic Forum in Davos. Lisa Abramovich is sitting down with Breyer Capital founder and CEO. Lisa.
Thank you so much, Menace. Really appreciate that. I am here, so pleased to say, with someone who has intense experience in the technological world, Jim Breyer of Breyer Capital. I know that you work very closely with Steve Pagliuca. You have invested alongside him with the Celtics. We're not going to speak about that. But you also have been investing in similar ventures. And earlier today, he talked about how there is a feeling here that feels reminiscent of 1999 with the tech boom. Do you agree?
It's 99 in terms of walking down the streets and the buzz around Gen AI. What's different versus 1999? So I agree with Steve on 95% of his views, but the underlying technologies and the magnificent 7 or 8 companies are extraordinarily well-led and well-positioned into this new world. That wasn't the case in 1999, where there were companies like Yahoo that were not necessarily great leaders in the technological underpinnings of that next generation. So there are always differences. History sometimes repeats itself, sometimes rhymes, but what I would offer is I've never seen so much unprecedented demand, whether it's big banks, federal governments, leaders of Europe, and the entrepreneurial activities. I've never seen so much demand for what AI as a core in terms of simulation, new drug discovery. This is unprecedented.
And we've heard this from pretty much everyone, and this to me is really a key question. Is there a company that you see out there that is going to be a Facebook or a Microsoft in the world of AI in the future?
Well, I love that you mentioned Facebook. Mark is near and dear to my heart, a genius. I met him when he was 20 and invested and joined the board in 2005. Meta is extraordinarily well positioned in AI. There will be new Facebooks and new NVIDIAs that are being created. There's one very significant difference again versus the late 90s or the social networks of 2005. And that is interdisciplinary skills are more important than ever. So the days of me just backing the great team out of Stanford Computer Science or MIT or our other great universities, those are gone. There are certain investments that still work that way, but the big upside is, and this is public and private, where interdisciplinary skills in computation mixed with big verticals like finance and healthcare. If you don't have both, you're not going to be part of that next generation where we think of the Microsofts and Facebooks and where they've come from.
I know that you talk about certain verticals, in particular with life sciences. It's something you've been very interested in the sort of technology that can advance things there. I'm just wondering how actively you're deploying money now versus educating yourself with what's out there and waiting for the prototypes to become a little bit more solid.
Well, it's a wonderful question. Since 2017, I've invested in 12 spin-outs in the world of medicine, out of Memorial Sloan Kettering, UCSF, where we start with great medical professionals, doctors and nurses, and data that might be best of world at MD Anderson versus even our best cancer centers. So I've done 12 of these over the last now 7 years. And I have to say, it's been a phenomenal surprise. My job is to go out and now find the brilliant, genius 30-year-olds at Microsoft and Apple and Alphabet that want to do something very mission-driven. And the world of medicine and life sciences and how it's absolutely colliding with computation is something where I'm really finding a lot of receptivity for, again, that top 0.1% of machine learning artificial intelligence developer.
Well, hopefully artificial intelligence can solve cancer and cure it in the upcoming
We're going
years.
to help.
I hope so. I hope so. Going forward, one thing that you've been very strong in is investing in China. And I do know that there is the biggest delegation here from China going back to 2017. How concerned are you about the ability to invest in a country that so many people say is uninvestable simply because of a lack of a certainty and certainly friendliness around the regulations?
Well, it's no secret we're at very challenging times in terms of the international politics. I never think of China, though, as uninvestable. We've backed, in the last couple of years, a number of wonderful entrepreneurs who moved to Singapore. There's no doubt that in the areas that I'm most passionate about, quantum and AI, all my investing for the last several years has been in the U.S., where I believe the best talent and opportunities are.
But are you still actively investing in China? Do you think that there still are plenty of opportunities, even as you said, the entrepreneurs are moving to Singapore?
I took an 18-month pause. So I paused about 18 months ago, even if it's an e-commerce company. There are some remarkable companies we invested in several years ago. Shein is doing quite well. But no, I think for the foreseeable future, although I'm not a political analyst, I don't see the U.S.-China relationship this year becoming worse. With the elections, I have no idea what 2025 looks like, so I've paused.
In the meantime, you were talking about how here at Davos you've met with a lot of generals and talked about AI and the use of it in war. How do you see that evolving as you kind of look at the landscape and understand what's going to take off?
Well, I've met with General Milley, admirals, and senior Secretary of State personnel. We're ahead in the U.S., but we all know that with AI, not just generative AI, but simulation technologies, what quantum will do to security, if our three-letter agencies, our Army, our Navy, our Air Force isn't investing aggressively in these technologies, we'll be surpassed. The good news is we're well ahead, but there needs to be an understanding, and I think there is with the people I've spoken to. There's nothing more important than understanding what these new technologies mean in terms of national security. And I would also say I've met with a number of medical leaders in hospitals. Ransomware attacks last year in U.S. hospitals were up 60% each month. So 6x, 7x ransomware attacks for hospital and patient data.
Unfortunately, we have to leave it there. Jim Breyer, thank you so much for taking the time. Back to you, Menace.
Lisa, thank you very much. Great conversation there about the next generation of meta to come in our world from Davos. Time now for your trading diary. Let's see what you need to keep an eye on for the rest of the week. President Biden, he speaks at 2 p.m. on Bidenomics. Friday, you're going to get your U.S. existing home sales and more economic data from UMich consumer sentiment. We then close out with a little bit more Fed speak. San Francisco Fed President Mary Daly closes off the Fed speak before we go quiet. And tomorrow at midnight, the next U.S. government shutdown. That's the deadline. Let's see whether they can fill or kill on policy there. This was Countdown to the Open from Davos and New York. A very good morning.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, taking a look at the markets here. Quite interesting. Tech getting that rally, 1%. It's like a relief that we're not seeing a sell-off in the front of the bond market today.
Absolutely. There is certainly some action in the bond market, understandably, given the claims data that we've seen today, plus the Bostic comments. Widen the lens a little bit. Take a look at the last few days, and I think that probably puts today's move in context. If you take a look at the S&P, for instance, last 4 days, beginning of the week, Monday, Tuesday, Wednesday, Thursday, we're down by 2.75%. So yeah, we were due a little bit of a rally. Nothing ever goes in a straight line for this long. But yeah, yields are higher. That's a story that's worth focusing on, certainly in tens. And if you take more than just 1 day's price action, stocks are still very much down.
Yep, and I'm just so fascinated with some of the individual movers as well. Humana, for example, looking at some cost pressures there, but like the amount, how hard some of these stocks are getting hit is, to be honest, a little staggering to me.
So Watches of Switzerland is the example I would pull out from Europe. It's down by 30-odd%. It's had a really bad day on some updated guidance. I don't know, I hear what you're saying about the fact that some of these moves are staggering, but I remember the last results season as well, producing some really big single stock intraday moves. And the problem with that is that for every big move down on the downside, you get a big move on the upside. And as a result of which, in some ways, the market doesn't travel very far on the back of it. Single stock stories, yeah, they're there. Individual stock stories, maybe not so much. Like, look at ASML today, up on the back of TSMC really nicely. That's a real heavyweight moving to the upside.
Yeah, let's just get a quick check in our U.S. market. So the S&P is just up 0.3%. As Guy was pointing out, though, on an individual stock level, it can be quite interesting. He mentioned TSMC, so it makes chips to Apple, to NVIDIA. So they projected revenue growth of at least $18.8 billion in the March quarter, right? That was much better than estimated. So the whole stocks index, the semi-index, is moving higher on that. And then I was mentioning on the downside that Humana story, cutting its full-year adjusted outlook because medical costs are higher. We heard this from United Health last week. That stock got hit really hard. And then you have another 10% on Humana to that as well. So it's quite interesting, I think. I know Guy's not making that much of individual names, but I'm into it.
No, I'm interested. But I think it's worth also taking a step back. Costs are still elevated. What does that tell you? That tells you that inflation is still a factor that we need to fold into this debate. It also tells you that while the top line, and you're seeing this with a number of different companies, the top line is still moving, there's definitely a continued margin squeeze that we need to pay attention to. So while the top line is slowing a little bit, the cost pressure is still represented in many of these stock stories that we continue to talk about. But I just come back to it. Look, the market has moved already down a little bit. You've got a whole bunch of single names that are moving around a bit. Can you take some sort of bigger theme away from this? Maybe. You fold this in with the claims number. We're not seeing big layoffs. Costs remain elevated. You take a look at what is happening with the rate story. You're still seeing a cost of capital that's likely to remain elevated for quite some time as well.
One of our producers was talking about margin maintenance would be the theme of the quarter. It's not sexy, but it's interesting. But anyway, we're going to talk about that as well as a lot of guests from Davos. Chock full from the World Economic Forum in Davos. We're going to talk to Steve Schwarzman momentarily, the CEO of Blackstone, Christian Lindner, the German finance minister. Really interesting piece in the FT also on his struggles at home, and Brian Moynihan, Bank of America chairman and CEO. We're going to have those interviews coming up next. This is Bloomberg. as promised, let's take you to the World Economic Forum in Davos. Bloomberg's Francine Lacroix is joined by Blackstone Chairman and CEO Steve Schwarzman. Fran?
Yeah, thank you so much, Alex. I'm really delighted to be here joined here by Steve Schwarzman. It's day 4, so we're struggling to talk a little bit, Steve. I mean, it's been like nonstop this year because there's been so many people. The talk is, of course, about the conflicts, the impact that has on the economy. Are you confident about 2024?
Well, I think 2024 will be a good year. It'll start out slower in the sense that, interest rates are still pretty high, and the Fed will keep them that way. Everybody has their own guess, probably till the second half at some point in there. So that'll sort of have a little bit of sort of a baffling effect. Stock market had such a run in the fourth quarter that you wouldn't expect that to really take off and go, and the economy is slowing a bit. That's normal with high interest rates. So on the other side of the ledger, the expectation that interest rates are going down is creating animal spirits again. And we did, at Blackstone, we did 6 private equity investments in 6 weeks at the end of the year after a slow year. And we're much busier now. Yeah. In a way, it represents some type of capitulation for people who were holding back for 2 years. So we're optimistic. Yeah. For this year.
But Steve, are you worried that if actually we don't get those cuts promised by the Fed, because a lot of the good news is already priced in markets, that people will start waning on the deals a little bit? So for the moment, you're optimistic. Is second half of the year a little bit trickier?
We will get the cuts. Okay. Because the way we measure inflation at Blackstone, we're already right around the 2%. The fact that the Fed's using different numbers for rents and real estate, we think they're sort of looking at 6% inflation in rents and residential real estate, and we're the largest owner of residential real estate. We think it's 0 to 1. Let's bet on us on this one, because we're the people actually doing it. And if you correct the index for that difference between what's really going on and they're saying it's 6.2, you get around 2%. So I think I'm quite confident that they'll be lowering rates. Some people are like overly enthusiastic about when they do it. We don't really care when they do it. It's just the fact that we're going to go from a period of rising rates to a period of lowering rates.
So where do you see the best deals? Where do you think that the market is really ripe and kind of ready to go?
Well, there are different things. Data centers now are really interesting. Energy transition, that's more of a book value kind of thing, because you're building things typically. And we've done extremely well in that area. We have healthcare types of things where you're inventing drugs through stage 3 trials. That's uncorrelated. We're looking at very interesting things in European real estate. Now, that's counter to what people...
counterintuitive.
Right, counterintuitive. So there's always an actual reason why it's interesting, not an assertion. So the reason is that people who own real estate in Europe used to be paying almost nothing in interest, because rates were negative for governments and even deposits. And now it's costing them about 500 basis points more to carry their positions. If you are highly leveraged, then you're having a lot of difficulty holding your positions, and the actual underlying real estate isn't necessarily growing that much.
Right.
So the way out of this dilemma is to sell assets.
Yeah.
And there's hardly anybody in Europe who wants to buy them.
Yeah.
But at Blackstone, we're the largest owner of commercial real estate. We've got plenty of money. We want to buy that real estate, but only the good kinds of real estate, like the data centers, the warehouses, the student housing, which is all doing well. So what we normally do is tell them to go back and just bring us that stuff, and we'll buy all of it to give them liquidity. And we're finding that that's happening a lot, and that's creating things, because we only buy them at a price we think makes sense. So we now have not only willing sellers, but sellers who have to sell, and a very willing buyer. So we're going to create a lot of very interesting investments. So what you find, Francine, in almost every environment, if all you're doing is what everybody does, it's not so interesting. If you have different inputs, you can create things with very good rates of return.
How do you look at AI? So is AI something that's embedded in the future of what you're buying, or do you go straight for AI play?
There are certain types of things, when you look at them, you have to, as part of an analysis, say if AI was more developed, is that good or bad for this type of business? So there are certain types of businesses really not good for, certain types can really be improved. And so that's now on the checklist, if you will, for due diligence. And AI itself, and we've marshaled, almost all of our portfolio companies. I did a Zoom with all of them, all the CEOs, about 6 months ago. And I told them AI is no longer an elective course. This is core curriculum. And you're going to learn to love it. And the reason...
And understand it.
Well, understand it as best you can, and we'll help you. In effect, Blackstone Parent. And a lot of companies, we embed data scientists to serve as a link. One of the things that we really want to do is make sure that every company has a plan, because if you don't and somebody else does, this is an area where if you're not the first mover and your competitor implements AI and they have bigger margins or more new products, then you're going to start losing market share. And some people, some businesses who aren't in the game are going to be really adversely affected. And I explained to them, that can't be you. You don't want to oversee somebody else taking your market share and hurting your business. They all understand this.
Okay, this is a good thing. Steve, do you worry about liquidity crises in certain pockets? I know Carson Block was talking, for example, about BXMT.
No, not. We have, I think, 97% of loans paying, and we've done our own analysis on that, and we're not particularly concerned about that. In terms of liquidity, there'll be office buildings which will have that issue, although office buildings, particularly in the United States, as a rule, are a lot lower leveraged than they used to be when you were covering the global financial crisis. Then office buildings were 75 to 80% leverage. Now they're 55 to 60% leverage. So to the extent that those buildings get in trouble, there's much more equity in them. So this is going to be an unfortunate moment for the actual owners rather than just the banks.
Do you think private equity has a place in people's 401ks?
Oh, absolutely. Geez, we're selling a lot of money to private wealth. 25% of Blackstone's assets are to private wealth customers. So that's $250 billion. And, that is a little cyclical because private wealth customers sometimes get affected more than institutions when markets go down or there are threats of that type. On the other hand, there's $80 trillion with probably, that's as a market opportunity, with probably only 2% penetrated. When I started in 1985, back in the Middle Ages, that's just the way institutions work. Institutions now are 25%. And the reason is you get much higher returns over time than the stock market. Probably around 500, 600 basis points. You give up some liquidity, and now we're inventing new products that can be put into liquid form, if not daily liquid, periodic liquid. So you give up some liquidity, but you make a lot more money.
Steve, talk to me about the U.S. elections. So you've always had a candidate, and you're on the fence for the moment. Like, how will you make up your mind?
Well, all I do is read polls and media, and we've only had one election, and it wasn't even an election; it was a caucus. So I think I'd like to see what the public thinks rather than what I think. So that'll take a little bit.
But is that because you want to back the winner, or because you want to see someone that could possibly beat Trump?
Well, I just want to see how the game plays. And the world's complex with all of this presidential politics now. And so I've always learned to trust my instincts. When I want to see more, I just want to see more. And obviously I'll make some decisions at some point. But this is the start of the game. For people who've been covering this like a blood sport, it's been going on for a year and a half already, but the actual game has just started.
But New Hampshire is a big one, right?
Excuse me?
New Hampshire is going to be interesting.
Yeah.
That's next week. But is there a chance that the Republican nominee is not Donald Trump?
Ask the pollsters. Ask the political experts.
You trust the pollsters?
What's amazing? Having had such a bad record in the 2020 elections, and even in the midterms, they got Iowa virtually identically to what happened. So Iowa's actually like a major victory for polling, as well as the winner.
So we talk a lot about, what would happen to the economy, to domestic policies, to foreign policy under Donald Trump. What do you think will happen under, a second-term President Biden?
Well, we've seen a lot of that, and we've now got $2 trillion deficits with no end in sight. We've got our debt to GDP going up. We've got open borders with 8 million people coming over. I don't know that the country, frankly, is prepared for 4 more years of that, because those things all poll very negatively. So I can't really project what would happen.
But see, when the debt becomes an issue, would it be a failed treasury auction? Like, could there actually be a big financial event that makes people, wonder about the future of this?
Well, theoretically, usually financial crises come when you don't expect them. and they come quickly. I think we have a ways to go, in terms of people buying treasury bills. I don't worry about that as a practical issue. You have a country like Japan, which, is like 250 to 300% of GDP. They're still there.
Yeah.
Now, most countries who have that situation self-finance. And the U.S. is dependent upon more global finance. So it would be good if we could get our financial house in order.
Steve, thank you so much for joining us today. That was, of course, Steve Schwarzman, Blackstone Chairman and Chief Executive. With that, Guy, I'm going to hand it back to you in London.
Thank you very much indeed, Francine. Fantastic conversation with Steve. So much coming out of that. We're not done with Davos just yet. I want to take you over the road, take you to a panel discussion that is underway. It's on uniting Europe's markets. It's being led by Bloomberg's Stephanie Flanders. On stage, amongst others, ECB President Christine Lagarde.
Over the many hurdles that we have faced and that still exist in order to put in place a capital market. And I would be happy to expand on what we should do, what method we should use, because I have some views on that, having gone through 15 years of trial and errors, failing to achieve the ultimate results. And I think that artificial intelligence can help.
So Pascal Donahue, you are head of the Eurogroup. Christine has very admirably kind of placed this on the economic case for capital market union. You've stated it as a sort of priority for the group. How are you going to pursue that in the next year?
So if I could give the political side of the coin that Christine has described very clearly when she described the economics of it. So politically, as a finance minister working with other finance ministers in the Eurogroup, so much of our effort, so much of our focus has firstly been on budgetary matters, where finance ministers spend 95% of their time looking at how much they're taxing, how much they're spending, and how much they are borrowing. What little time has been available from dealing with those weighty matters over the many difficulties of the last years was then devoted to banking issues, to banking union, during the global financial crisis and in the aftermath of the financial crisis, building up and supporting our institutions and making all of the changes that were needed, the benefits of which I think we've seen in recent years. And I would contend actually that an opportunity cost and a justified opportunity cost has been the political focus on the need to build and deepen our capital markets has not been what it could have been because other priorities needed time and needed economic and political capital. The reason that is now changing is exactly for the reason that Christine has just outlined there. What she summed up very, very clearly is we think about capital differently at moments of economic transition. And we are clearly at multiple moments of economic transition, exactly at the moment that finance ministers need to normalise budget policy and reduce borrowing. And this has brought to the fore the issue that we are discussing here today in terms of what change could look like from a process point of view, and I won't go into it too much because process rarely makes compelling content.
They're already here, I mean, you know.
Well, still, I want to keep the audience in the room, but I'll still sum it up quickly. Prime Ministers last March in the European Council asked finance ministers to look at this project. We've been engaged in a number of different processes in looking at it, and it's now going to conclude in March, where we are going to say to the Commission, and to the next Commission in particular, these are the areas that we want you to consider, we want you to act upon, and we believe as a group of finance ministers we can make progress on these matters quickly. And just as the President outlined the different Ds of the changes that are happening, I think there's an ABC that we need to be aware of. What's the architecture of capital markets? How can we change it? And if we change it, what's the B of what it can mean to a business? And what's the C, critically, as a politician, of what it can mean to citizens? And that's the areas that we want to make further progress on top of the gradual and important change that the Commission have been making, and they have been, but we're all conscious that we have to do more now in the time ahead.
So, Christian Sewing, you're sitting there at Deutsche Bank. Does your heart leap when you hear that this is now going to be a priority? Do you see, I mean, is this something that is remotely exciting to you, or actually just not a big deal for your business?
Well, it's super exciting for me, and I mean, if you have followed me for the last 5 years, I think I'm one of the biggest pushers and fans of the European Capital Markets Union, and for a couple of reasons. Number one, Christine and Pascal both said it. I think we are coming into an era over the next 10 years, and forget about the banks, from a corporate industry where operating expenditure is, so to say, replaced by a priority by capital expenditures. The number of investments which corporates have to do in Europe in order to be in the game, in competition, from a digital, from a sustainability, ESG point of view, is tremendous. And I think those companies who are investing will be successful. Those companies who are not following on AI and ESG will not be there anymore in 10 or 15 years. And therefore, the necessity to invest is huge. We can't do it, as Christine is saying, even if I would love to do it. And I think, by the way, the European banks have done a tremendous job in cleaning up, being robust, healthy, sustainable, profitable. The numbers Christine just mentioned are impossible to stem for us. Today, unfortunately, 70% of the financing of the German Mittelstand is done via bank loans. In the US, it's actually 25 or 30%. The rest is coming from the capital markets. If you now think about how much investments will be necessary in the next years, the bank balance sheets, as robust as they are, will not be sufficient. And we also talked about the public finances. It doesn't work. And therefore, we definitely need the European Capital Markets Union. And therefore, I'm really, I think, the one who is again and again saying we need to make progress. Now, two things to this. Number one, I think we need to do a better job, including the banks, explaining why we need these capital markets. I think that in particular in Europe, in my home country, there is also from the society point of view still a kind of a distrust in capital markets. And that may go back to the 2008 financial crisis. And we can criticize it, but it doesn't help. We need to do a better job in explaining why it is actually necessary for keeping the wealth and the prosperous situation which we have in Europe. And I think this is one thing, it's education of the people, why it's so necessary in order to get Europe competitive and let it stay competitive. And the next item is, and I'm sure our partner to the left will talk about that, when we think about European capital markets, we think about kind of the deep markets for whether it's equity issuances, whether it's bond issuance. But usually, if you get a deep capital market, then the sidearms are coming. And what I mean with sidearms is venture capital, private equity. Other people, other players are coming to the game. And this is, again, necessary in order to finance new technologies, new emerging industries which are coming. And therefore, I think we also need to see the Capital Markets Union not only as the financing pot for traditional industries, but actually as our chance to attract new industries like the tech industry into Europe. We have the talent. We have the excellence. If you look at industrial AI, some German companies, European companies, are leading in the world. But we also need then the underlying financing, and therefore my heart is leaping if I hear that. There we go.
Nadia Calvino, I guess we can add you to the list of people that also, or the European Investment Bank also can't afford to finance all of the things that have been talked about. But what role can the European Investment Bank play?
Yes, two thoughts from my side to complement what already has been shared. And let me start where you started yourself, which is this feeling of déjà vu. Now, I was responsible for financial regulation around the euro crisis. I left it in 2014, and by the time we already had the clear diagnosis that capital market union was a top priority and that we needed to move as fast as possible in this direction. 10 years later, we are still discussing, despite the fact that I always agree with Pascal, I think that we can spend years discussing what the ABC is, and maybe it's going to be more difficult to reach an agreement on that. So my approach to this would be, let's do it. Let's start somewhere, and find some low-hanging fruit or some realistic element on which to start. It can be a market, it can be an instrument. I will come back to this in a second. But an additional reason to Christine's, to why we absolutely need it, is that for the climate transition, we need scale. So we have the technologies, we have wonderful startups and companies that have developed the technologies that are going to allow Europe to succeed, to rise up to the challenge, and we will and we can do it, but we need scale. And so it's not only a matter of capital markets union, it's also a market of integration of our markets and making Europe have the sufficient scale for this to become profitable and to become affordable. Because as Pascal said, these new technologies cannot be only for rich citizens or for wealthiest states. This transition needs to reach the whole world. And so I think that it is of the essence, and it's urgent that we actually proceed with this. And this brings me to my second point, which is what can the EIB do? And as you know, the EIB has, I think, been very successful in becoming the climate bank. We fixed ourselves a target of 50% of our business in climate finance. We outperformed this target, not only in the bank, but as a group, together with the European Investment Fund. Actually, I can tell you, we will be disclosing the 2023 results next week in detail, but I can already tell you we've made 49 billion euros in green investment in 23, up from 38 the previous year. So, the progression is, I think, outstanding. It is impressive. Mm-hmm. And we were also pioneers since 2007 issuing climate awareness bonds. This is the pioneer instrument of climate bonds, of green bonds. Why don't we start there? Why don't we try to find an area, a market where we have the taxonomy? Europe is in the lead in developing these new instruments, and green finance, there's a strong political commitment to the climate transition, and I think the EIB should indeed play its role in being a catalyst, de-risking investments, supporting financial sector, also taking on new instruments and trying to explore new financial engineering instruments that can allow us to fund the necessary investments and mobilizing public and private partnerships, which I think are going to be necessary if we are to succeed, which we will. Thank you.
Roelof Botha, you're sort of smiling at the end, and I'm sure you're very polite anyway, but you look like you're being particularly polite when you sort of have this feeling that a lot of what people have just talked about is completely irrelevant to you. This project is partly about having more Sequoias, sort of deeper sources of venture capital as well as other sorts of financing in Europe. And I don't get the sense that any of this would sort of fundamentally change the way you think about Europe. But maybe, am I completely wrong there?
That's mixed. Firstly, thank you very much for having me here. I feel it's an honor to be invited here today. At Sequoia, we back founders that build early-stage companies. And over the years, we've backed Apple, Oracle, Cisco, NVIDIA, Google, PayPal, YouTube, Instagram, WhatsApp, the list goes on. So the companies we back today account for 27% of the NASDAQ when they were private companies. So we operate in a very different part of the universe. And candidly, I'm kind of daunted with the challenge that you face, because we deploy small amounts of money in founders who have a dream to build for the future. But I feel that in our business, money follows the opportunities. And so we've been active in Europe for over a decade. I remember in May 2010, I was introduced to a young company in Copenhagen called Unity. There were 30 people in the company, and I hopped on a plane and I flew to Copenhagen immediately. And we made an investment in that company, and today it's a global winner. They have 2 billion in revenue. It's a big public company. We did that with UiPath in Romania. So From my point of view, there's a tremendous amount of opportunity in Europe, and we now have people on the ground in Europe looking for opportunities. Last year, 11 of our 44 investments were in Europe. We have a fantastic investment in a company called Robco in Germany, building robotic solutions. Penny Lane is a software company in Paris. We have an early stage AI company called Dust that's also based in Paris. So I see tremendous opportunity from the bottom up with founders who want to build for the future, and hopefully that becomes a driver of economic growth.
But is Europe, just to go back, is Europe already a single market as far as you're concerned? I mean, is that, what are the, do you face any obstacles?
From our narrow point of view, from a capital market point of view, it really is the same, because we can hop on a plane and go anywhere and make an investment. The challenges are more from an operating point of view, where, you know, what the founders tell us is they want easy access to deep pools of talent. So Penny Lane wants to concentrate all the best talent it can in Paris, from wherever. They want predictable and consistent regulations, and they obviously want a large market opportunity. But I'll say the other thing that's changed about European founders, by the way, part of the reason we're so enthusiastic about being here is that they have global ambitions. I'll be honest, when I first traveled to Europe 20 years ago, I felt that founders here were aiming for small exits. They were happy with an acquisition, and now they really dream big.
Your phrase, money follows opportunity, rather than the other way around. Did I go the way around? Yes. It just makes you, I mean, are we focusing on the wrong things? I don't know who wants to take it up on, but, you know, Pascal, should we be thinking more concretely about the opportunities in the broader economy and let the money come to it?
But that's what we are doing, and I completely agree with the analysis you've just offered there regarding the outlook for European entrepreneurs. If I look at how we are doing with our share of patents in different very important parts of the global economy, and if I look at the entrepreneurs that I meet in Ireland alone, their ambition, their innovation, you'll be very familiar with Stripe.
Of course.
You've invested in.
At the seed stage, we were the first investors.
You're one of the first supporters, and now a globally successful company with peers nowhere near that scale yet, but many peers who are as ambitious in Ireland and all over Europe to do that all over again. But it's precisely because now the appetite is there in the European economy for that kind of innovation, with the leaders able to do it. The question then becomes, how can Europe itself play a role in providing the savings and the capital to contribute to that, and obviously, ultimately, to benefit from it as well. And to build on your point, it's about making sure the money is there to follow the opportunity, and not just, which, while of course we hugely welcome it, money coming in from other parts of the world, which played a role in European companies growing to the scale they are. So it's because of that practical opportunity and need that we're all now devoting time to how we can make it happen. God knows it will take time. But in Europe,
to a panel on uniting Europe's markets done by, of course, chaired by our very own Stephanie Flanders. We'll get back to that in a second. We're now joined by Germany's Finance Minister, Christian Lindner, for also a great conversation on the future of Europe and the future of Germany. Minister, thank you for joining us today. There's a little bit of debate on whether Germany will see a recession, a hard recession, whether you can avoid a recession, because this is only a technical recession. What is the House view of the Ministry of Finance?
Well, we have to avoid recession, and so Germany has to change some policies. Last year and beginning of this year, we made efforts to consolidate our federal budget. Our debt to GDP ratio is in the decline, but our next project has to be to strengthen the framework conditions for our economy by supply-side measures, which means more flexibility for the labor market, public sector investments, and cutting red tape for our economy, and then the growth perspective will improve, I'm sure.
But Minister, there's, I guess, an orthodox view in how to deal with the economy in a downturn, which is states should invest, of course, when an economy is in downturn, make provisions for when bad times are ahead. Now, your government are in favor of suspending, for example, the constitutional debt brake and helping Germany out of a crisis. You are the one blocking it. Do you worry? Do you not worry that this means more trouble ahead?
No. Well, in fact, we have to fight inflation. It would not be good advice to counteract the ECB's efforts to reduce the inflation rates by more public sector expenditures. But having said this, we maintain a very high level of public sector investment. Actually, it's higher than pre-pandemic, and so there is no choice we have to make whether we respect the debt brake or we invest taxpayers' money. We do both by deciding for priorities.
But Minister, it seems that if you had to choose between fighting inflation or focusing on growth, you'd rather fight inflation. Is that fair?
If I would have to make the choice between fighting inflation or fostering growth, then in first instance we have to reduce the inflation rate. But I think this is not really a conflict because we can focus on the supply side policies, and then we in the midterm we improve the growth perspective of our economies, especially the SMEs, and we fight inflation in the same political situation.
Minister, the country's highest court has declared, of course, the transfer of funds, the special funds outside the regular budget to be unconstitutional. This ruling has really plunged the government into a crisis. Were you not prepared for the scenario?
No, there is no government crisis, there is no budget crisis in Germany. But in fact, the Constitutional Court has made for the first time a decision about the debt brake of our constitution. This is quite new. Switzerland has more experience with their debt brake, so it's the first decision, and we had to decide for the consequences. And this ruling of the Constitutional Court, it was so unexpected, and some principles has been shifted by the Constitutional Court. So now we have made the necessary decisions. Now we are compliant with the Constitution, and now we can work further on the turnaround in our fiscal policies and the growth perspective.
But Minister, you say the government is not in crisis, but you can't tell me that the three parties are getting along. How would you describe the current the three parties in your words?
It's three very different parties: two left-wing party and one more or less centristic social market economy-driven party. It's the Liberal Party, which I have the honor to lead. And of course, we have to consider policies, and there are different perspectives. And the good news is, in the end, we find consensus.
So there's no danger of a breakup?
There is no danger. Frankly, the process of decision making could be more silent, could be faster, but in the end there are good decisions. Now think about the German situation after the unprovoked war of aggression against Ukraine. After the Russian attack, we had to completely reinvent our energy infrastructure, which we were so dependent on Russian energy imports. And last year here in Davos there were still concerns whether Germany is capable of managing this situation. And we did. Of course, the growth is not satisfying, but others thought there would be a huge economic crisis in Germany, but there hasn't anything like this.
We saw a lot of people on the street on Monday, a lot of protests because of also, the negotiations.
The farmers.
Some of this,
We're talking about the farmers.
I'm talking about the farmers, but there seems to be in general just a lot of discontent because of the negotiations in the budget cuts.
No, I think my explanation is slightly different. We had a decade with very low interest rates, and now Germany is paying, in the long-term perspective, normal interest rates, which means, in consequence, not 4 billion euros, but 40 billion euros of interest in the public budget. We are not familiar